Hey,
And we are live. Welcome to this episode of Tax Tips Tuesday. I love this conversation. Listen, this is where we start playing money chess. Most of us are playing checkers, right? It's that onesie and twosie. We get some income to pay some income. But when we really start to use our thinking cap and upgrade our growth money mind shift, we understand it's about playing money chess, understanding the rules of the game because it's not how much money we make, it's how much money we keep and how much money we can pour into future generations. And today we're going to talk about one of my favorite topics, which is how to make your child a millionaire, $1 million baby, we call it. And by the way, remember, there are many ways to make your child wealthy. We're going to talk about one strategy today that I think is brilliant. And to help us with that, we have our incredible expert, Miss Christiana Cardi. Take it away.
hi, Miss Leah. It is awesome to be back. And I'm
Yeah,
always excited to, as you know, always excited to talk about taxes. So
I
today
know.
we're going to talk about something that is very near and dear to me, and that is creating wealth for future generations. So, given my background, this is something that I help my clients with because I know what it feels like to come from insufficiency. And so I want to use my skills and my experience to help families ensure that their kids do not have to experience the things that I did. And one of the ways that I am happy to do that is by helping them use their businesses to pay their kids and then use the income that the kids get from that to help them create lasting wealth. Not just lasting wealth, in most cases, tax free wealth. So,
Yes. And tax free is very, very sexy, right? We can all know how to make money, but it's how do we have that tax free wealth, that secret sauce? We have a few people that have joined us, and I'm going to let you go ahead and do the deep dive. We have Victoria joining us. Thank you for piping in. Thank you. Let us know where you're tuning in from. And then we have, of course, our Queen Dr. Leslie Flowers, and she talks about right. Think and Grow Rich. She teaches us about how the thinking, it all comes from the infrastructure, which is our thinking. And then the foundation is the financial tools that we talk about. And Tanya, thank you for joining us. It's great to see you. And my good friend Daryl Meadows. Folks, if you are looking for some strategies on how to provide benefits really, really affordable for your employees, please reach out to my good friend Daryl. Do taxes and sexy belong together? Yes, they do, because this
yes,
tips
they do.
absolutely belong together, especially when you talk to Chris, because she calls taxes a treasure hunt. Her thinking about taxes, I mean, it will change the way you think about the IRS. I promise you, Queen Doctor. So go ahead. So let's talk about a strategy about we're a business owner, we're an entrepreneur, and we want to help to create millionaires with our children. Take it away.
Okay, so this is common because everyone is talking about it over the internet. But what I think is missing is that no one is really doing a deep dive into it. How does it work? And then go beyond the tax deduction for the parent to how do you use that to create wealth for your child? Not just, like I said, tax free wealth for your child. So I think it is common knowledge that if you're a business owner, you are able to pay your child 17 and under from your business up to the standard deduction, whatever that is for the year. This year it happens to be $15,000. So you can pay them up to up to the $15,000, and there'll be no social security taxes, so no FICA and no income taxes. So that is tax-free income to the child, and the business gets a tax deduction for that. Now, most people are like, "Ooh, yeah, I got a tax deduction," but I'm like, "No, no, 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 no. That's not it. Saving money on taxes is great, but what are we going to do with that money?" So I have my clients, all their kids contribute the max to a Roth IRA. And the Roth IRA is always a self-directed IRA. And I love a self-directed IRA because the client now has options as to how that money is invested. They control that IRA. So I have clients with multiple kids, and that's the part that I love the most. When I have clients with multiple kids and we do this, now we have the ability to give their kid to have the kids become partners inside their Roth IRAs and now pool their money together and go out and invest. So they can invest in real estate. They can invest in cryptocurrency. They can invest in non-traditional investments like peer-to-peer lending, all these different things, so that they now are creating wealth. But here's the best part: the contribution to the Roth IRA is tax-free. The growth is tax-free. The distribution, as long as distribution is taken at retirement age, distribution is tax-free. So now here you have, say, let's say I have a client who have 4 kids. No, I have four kids, but my client with 3 kids is doing this because she owns a partnership. So there's some rules. So let's talk a little bit about the rules first, and then I'll talk about what my client is doing. So the rule is that the company has to be owned either by 100% by one parent or 100% by both parents. It cannot be a corporation. So that means that if it's an S corporation, you are not able to pay your kids directly from your business and benefit from that, because corporations are not allowed to do that. So it's either an LLC or a partnership. But here's the thing. This is a tax code, right? And so there's loopholes for everything. And a loophole doesn't mean that you're breaking the law. A loophole just means that there's an angle that you can use, that you can bend it so that you can get that benefit, but get it legally. So in the case of this strategy, it is called a family management company. What that means is, because the corporation can't pay the child directly, the parents can now open another entity, which can be an LLC or a partnership. That LLC or partnership now is responsible for paying expenses on behalf of the S corporation. And part of those expenses are the kids, paying the kids. Now you are able to pay the kids. The corporation is still getting the deductions because you created that loophole to do that, right? And so another thing that you have to be careful with, though, is that you have to ensure that your kids are genuinely working. So it can't just be, I'm going to pay my kid $15,000 because there is a strategy that says I can do that. They have to be genuinely working in the business. There has to be an agreement as, okay, this is what their job is. This is the role that they play. This is what they do, and everything. So that if you get audited, and I'm not saying that you automatically get audited. It is just, whenever I speak to a client, I am always thinking, what happens in case of an audit? So we're making sure that our T's are crossed and our I's are dotted. And so we make sure that we have a description for the work that the child is going to do, when and how they're performing that work, and how much it is that they're being paid. Okay. So then the next thing that a lot of people do not think about is, well, I'm paying one kid X amount, and I'm paying the other kid X amount. Can I pay them the same amount, or is there a specific amount that I should pay them based on age? And that's a question that I get a lot. Well, my kid is only 7 years old. Can I pay them the full $15,000, as this year is $15,000? Can I pay them? Well, that depends. What is the kid doing for you? A 7-year-old, what work is your 7-year-old doing that justifies paying them $15,000, right? So, say for example, if my kid is constantly in my videos, doing marketing with me, they're in all my tax videos, then I can justify paying $15,000 to that child, because you are literally the face of my brand, right? So it just depends on what they're doing, how often they're doing it, and so to decide how much it is that you're paying them. So this is just one way that you can. This is one strategy, and tax planning is not do it all, like everything in one, right? Everything fits differently for different people, so it's not a general thing. It is specific to your tax situation. So paying your kid, if you're paying your kid in your business, they don't want to pay any taxes. That's one way, but there are other ways. So let's say, for example, I'm working with a client whose income is really up there, and their business is a C corporation, and they're wondering, well, how can I pay my child and still get the benefit? Well, you can't exactly do that the same way, because as like the IRS says, corporations are not allowed to do that. But as a corporation, you're still allowed to employ your child. So now you get the opportunity to pay your child way more than the standard deduction if you choose, just knowing that there will be a tax, there's going to be a tax liability attached to the child. So what I have my clients do is I have them, I have them do the job description, everything that the child is doing, and then I decide how much it is that the child is going to get paid. Now, what I do as a rule is I try to keep the pay that the child receives in the 10% tax bracket. So now that client is trading a 32% marginal tax rate for a 10% tax rate, right? So imagine the difference that could make. So let's say this year, client has 4 kids. The client is a doctor. 4 kids, all are under 17. Doesn't really matter because it's a C corporation, right? So now the client is for all 4 kids this year. I'm gonna have them pay those kids $26,925. Now, why that specific number? It's because the standard deduction for single this year is $15,000, and 11,925 is the top of the 10% tax bracket. So now that child will pay taxes, but the taxes that they'll pay is 1,192 whatever, $92.50 or whatever, something like that, right? So if 4 kids are paying $1,192 in taxes, they're paying less than $5,000 in taxes, but they're reducing their taxable income
Right.
by almost $120,000. Now, if you calculate the parents' tax rate on that $120,000, they would have paid, the marginal tax rate is $32,000. So they would have paid almost $30,000, a little over $30,000 on that $120,000, right? So now that is a huge savings compared to if my kids get above the standard deduction, and yes, they won't get the tax-free, the no taxes on the salary, but they are able to help shift income from the parent to the child, and it's saving them way more taxes than the taxes that the child is saving if they were not getting paid. If they were not getting paid, they were getting paid up to the standard deduction only. So, and on the other side of things, the ability to create wealth with that income is still the same, except now the child has the same ability to have a Roth IRA, same 4 kids Roth IRA, and the 4 Roth IRAs can now partner together, which gives them a lot more spending power. So it is not always just about how much you're going to save. It is how much can I save based on my situation, and then what happens to those savings after. So if I have 4 kids, and let's say in year one contributed to a Roth $7,000, and now each kid we have an LLC inside of that Roth, and we become partners. The 4 kids become partners. In year one, instead of having $7,000, each person has $7,000, which reduces your ability to invest on a large scale. You combine those $7,000, and now you have $28,000 to go invest in something. Now, can I have a down payment? Put a down payment on a rental property, maybe. Can we go do some peer-to-peer lending together and maybe 15% interest? And now it is earning money. It is earning money. It is growing tax-free, and the distribution is still tax-free. So again, every person's financial situation, tax situation is different. And so every strategy that is applied to that person's situation has to be unique. It has to consider what their financial situation is, what their tax situation is. So that when you speaking to someone as a business owner, when you're speaking to someone about taxes, you have to look out for those questions that they're asking you. You have to understand that the person who you're having that conversation with it can't just be checking boxes. It can't just be those questions like everyone run of the mill questions. It has to be questions that specifically address your situation, because you're a unique individual and your tax situation is unique and therefore deserves strategies that are unique applied to it.
Yeah, that's a lot to unpack here, but what I want people to really understand is it really is about playing chess. It's about knowing the moves, several moves down the road.
Mhm.
So what do you intend to do? What is your succession planning? What is your exit planning? When we begin with the end in mind, then Chris and I can reverse engineer those strategies for you. And we had a question that I want to highlight, although we've got a lot of great questions, a lot of great comments here, but this is one I get asked all the time. Can this be for a grandchild?
Okay, for a grandchild, it is different. So I tell my clients for a grandchild, what you do is you pay the parent, and the parent now has the responsibility to pay the child. So let's say I have grandkids and I want to pay my grandkids, right? Um, the law doesn't cover my grandkids per se, but it covers my child. So if I pay my child 1099 to my child, now the child now has is going to have a tax liability, but that child, if they have a business, can now pay their grandchild, their kid from that money, and the same will apply to them. So it is not there's not a direct route to do it, it's indirect.
Yeah, that's really, really good. And so we have a lot of great people joining us, a lot of entrepreneurs, a lot of business owners. Make sure you put in the chat who you are, what you do, because somebody is looking for you. I mean, we've got Mr. Mike Drop, David Jones here from the Hello LLC. If you want to get rid of your dusty, crusty business card and your website, now's the time to push the button and upgrade, just like Chris and I did. So I love that. I do have one other question. I don't know that it's off. I think it's a little off topic, but if you could answer this really quickly, um, what does it take to register an NGO in the US?
So I'm gonna be upfront and honest and say that this is not my lane, and this
That's
is not
not your lane?
I'll
Okay.
be, I'll be able to be comfortable to answer.
Okay, perfect. Well, that's what we wanted to share with you. If you have a direct question, please reach out to Chris. Listen, this is about strategy. I know that a lot of people always tell me, well, you know what? I have a tax professional. But my question is, what are they doing for you? Are they just asking you at the end of the year, how much money did you make? And here's how much money you owe. That's really, to me, that's not tax planning. Advanced tax planning calls requires somebody who's going to begin with the end in mind and know really who you are, what you're doing, and what you're trying to do with this wealth, and help you to reverse engineer, because there's over 83,000 pages in the tax codes, folks. Remember, it's about understanding how that tax code works and how we can bend it and optimize it for you. Now, bending it doesn't mean that we're doing anything illegal. This is everything that's above board. These are have all been vetted strategies.
Mhm.
And so we're talking about just understanding the rules of the game. And when we understand the rules of the game, we can keep more of our hard-earned money and put it into future generations. Most of us are playing checkers, and we're just going ahead and we're writing that check, you know. And what really changed my thinking was I had a client who his father bought himself a property in the Bay Area every year for like 30 years. They owned over 35 properties. And when the father passed away, the family had to write a check for over $5 million. And I asked him, well, you know, did you talk to your tax professional? And they said, yeah. They just told me to go ahead and write the check. And maybe that was all they could do, but I'm going to say they probably didn't have a strategist,
Mhm.
somebody looking at them holistically, proactively, and beginning with the end in mind and reverse engineering so that you could keep more of our money. That's why when people say, well, you know what, let's just tax the wealthy, you know, I just kind of chuckle because the wealthy people have people who are working for them to implement these strategies. So let's see. Yeah, Alan, I help people all the time with their taxes. Here you go, right here, helping them to save their money and build generational wealth. And remember, there's multiple ways. We're highlighting there right now the Roth IRA, but there are many different strategies that we could use. This is one strategy, one idea, so that you can create your baby to be $1 million baby. That's what my grandson's going to be. I only have one grandbaby. I need more grandbabies. So that's going to do it for us, Miss Chris. Do you have any parting words? How can people reach you?
I'm on LinkedIn, Chris Cardi, on Facebook, the same. Instagram, same. So all social media, it's either Chris Cardi or Christiani Cardi.
Perfect. Well,
And
that's going to do it for this edition. Go ahead.
the last thing that I would say is always remember that tax evasion is a crime, but avoidance isn't. Avoidance is using the tax code to legally keep more of your money. And think about what is your ROI when you write those checks to the IRS, and what would that money do for you if you didn't have to write those checks? That's
That's
it.
I love it. Now that I think is super sexy. And this is Tax Tips Tuesday. We're going to be here every Tuesday. If you have a question, if you have a topic you'd like to cover, please reach out to us. But otherwise, that's going to do it for us. Thank you so much. We appreciate you. Thank you for tuning in. Thank you for all the comments. We appreciate you. And we hope to talk to all of you soon. See you in LinkedIn, social media land. Thank you, everyone.